This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. There is a specific price level on every chart, and I mean every chart, where the fate of the next move gets decided. It is where buyers and sellers collide with maximum force. It is where breakouts launch or get rejected. It is where the biggest volume bars appear, where the most money changes hands, and where the highest probability trade setups form. This is support and resistance, but not the basic version you have seen in every beginner tutorial. Today we are combining everything you have learned in this entire volume series: the volume spikes, the climax bars, the trend health analysis, the accumulation and distribution footprints, and we are applying all of it at the most important locations on the chart, the key levels. This is where volume analysis becomes a complete trading system, because a key level without volume context is just a line on a chart. But a key level with volume context becomes a high probability trade setup that tells you exactly who is winning, how much conviction is behind the move, and whether you should be buying, selling, or standing aside. By the end of this lesson, you will have a complete framework for reading any chart in any market. This is the capstone of Phase 2. Let us get into it. Let us start with support levels and what volume tells you when price reaches them. A support level is a price where buyers have previously stepped in and pushed price higher. It is a floor, but not all support levels are created equal, and volume is what separates the strong floors from the trapdoors. When price drops into a support level and you see a volume surge with a bullish candle, a hammer, a bullish engulfing, a strong green bar, that is the highest probability buy signal in all of technical analysis. Why? Because the volume tells you that a massive battle just occurred at that level and the buyers won. Real money showed up to defend that price. Institutions placed bids. The selling pressure was absorbed and rejected. The bigger the volume surge, the stronger the signal. A support bounce on 2 times average volume is decent. A support bounce on 5 times average volume with a hammer candle is about as good as it gets. Now contrast that with a low volume touch of support. The stock drifts down to the level on light volume, hangs around for a bit, and then bounces weakly. That bounce is not trustworthy. There was no battle, no conviction from the buyers. The level might hold temporarily, but it is much more likely to break on the next test. This is especially important for the AI and semiconductor stocks. These stocks have clearly defined support levels that get tested repeatedly. When Nvidia pulls back to a prior support zone, the volume on that test day tells you everything. Heavy volume with a bullish candle means the level is being defended. Light volume with a weak bounce means be very careful. Now let us look at resistance, the ceiling where sellers have previously pushed price down. Same concept, but in reverse. When price rallies into a resistance level and you see a volume surge with a bearish candle, a shooting star, a bearish engulfing, a big red bar that tells you the sellers are defending that level aggressively. The bigger the volume surge, the more conviction behind the rejection. The stock tried to push through, the big players said no, and the rejection was violent. A resistance rejection on 5 times average volume with a shooting star candle is an extremely strong short signal, or, at minimum, a signal to take profits if you are long. On the other hand, a low volume touch of resistance is actually bullish, not bearish. If the stock approaches resistance and there is no surge of selling, the sellers are not interested in defending the level. The resistance is weak. And weak resistance often gets broken on the next attempt, especially if that next attempt comes with higher volume. So volume at a key level acts as a filter. High volume at resistance with a bearish candle means the level holds. Low volume at resistance means the level is likely to break soon. This one insight alone will save you from selling prematurely at resistance levels that are about to get blown through, and it will protect you from buying right as the stock gets slammed down from a level the big players are defending. Now let us talk about one of the most important applications, using volume to judge breakouts. Because nothing is more frustrating than buying a breakout that immediately reverses and traps you. This happens to almost every trader at some point, and it happens because they did not check the volume. A real breakout, one that is likely to follow through and lead to a sustained move, has volume that is significantly above average. 2 to 3 times the 20-day average is the minimum I look for. 5 times or more is ideal. The volume surge tells you that the breakout has institutional backing. Real money is behind the move. Funds are buying. The supply at that resistance level has been overwhelmed by demand. A fake breakout, a fakeout, has low or average volume. The stock pushes slightly above resistance. There is no volume surge, and then it falls right back below. The breakout had no conviction behind it, no institutional participation. It was just enough buying to briefly pierce the level, Probably retail traders chasing, and then it failed. Here is the rule. Never trust a breakout on low volume, period. If the stock pushes above resistance and the volume bar is not significantly above average, do not chase it. Wait. Either the volume will come in the next day or two, confirming the breakout, or the stock will fall back below the level, confirming it was a fakeout. Patience here saves you from the single most common trap in trading, and this applies equally to breakdowns. A real breakdown below support should come with a volume surge. A low volume breakdown is suspicious and often reverses. There is one more key level concept that volume makes incredibly powerful: role reversal. When a support level breaks, it often becomes resistance. And when a resistance level breaks, it often becomes support. This is one of the most reliable patterns in all of technical analysis, and volume confirms whether the role reversal is real. Here is how it works. A stock breaks below a support level on heavy volume. That tells you the level has genuinely been broken. The buyers who were defending it have been overwhelmed. Now the stock pulls back and rallies up to that same level from below. It used to be support, now it is resistance. If the stock gets rejected at that level with a volume surge and a bearish candle, the role reversal is confirmed. Old support is now acting as new resistance. This is a very clean trade setup because you know exactly where your stop goes, just above the old support level. The risk is defined, the signal is clear, and the volume confirms the conviction. The same works in reverse. Resistance breaks on heavy volume, stock pulls back to it from above, bounces with heavy volume and a bullish candle. Old resistance is now support. Another clean trade. Volume at role reversal levels is one of the highest probability setups because it combines multiple confirmations: the level itself, the volume at the break, and the volume at the retest. 3 layers of evidence. Quick pause. We are halfway through phase 2, and if you have made it this far, you have built a seriously powerful skill set. Hit that like button if this series has changed how you look at charts. Subscribe and tap the bell so you catch the next lesson when it drops. And if you are leveling up your career alongside your trading, check out Resume Zenith, professional resumes that stand out. Link in the description. Alright, let us bring it all together. This is the most important concept in this entire lesson, and maybe the entire phase 2 series. I call it the Triple Confluence. The highest probability trade setups occur when 3 things align at the same time. Number 1. A key level. A well-established support or resistance zone. A moving average, a trend line, a prior high or low. Somewhere that has proven significance on the chart. Number 2. A candle pattern. A recognizable reversal or continuation signal at that key level. A hammer, a shooting star, a bullish or bearish engulfing pattern, a doji. Something that tells you the price action itself is signaling a move. Number 3. A volume surge. Above average volume on that candle, confirming that the pattern has institutional participation. That real money is behind the signal. When all 3 of these align, you have a trade setup that works in your favor statistically over time. It does not guarantee a winner every time, nothing does, but the probability is significantly tilted in your direction. When only 2 of the 3 are present, the setup is still tradable, but you should reduce your position size. When only 1 is present, skip it. Wait for a better opportunity. This framework takes all the guesswork out of trading. You are not asking whether you feel like a stock is going to go up. You are asking whether the evidence supports a trade. Does the level matter? Is the candle telling me something? Does the volume confirm it? Yes to all 3? Take the trade with confidence. That is how professionals approach the market. Evidence first, emotions never. Let me walk you through exactly how to apply this Triple Confluence framework to the AI and semiconductor stocks you are probably watching. Step 1. Identify the key levels on the chart. For most AI stocks, these are pretty clear. Prior all-time highs, prior correction lows, the 50-day and 200-day moving averages, and any price level where the stock has bounced or been rejected multiple times. Mark these on your chart. Step 2. Wait for the stock to approach one of these levels. Do not force trades in the middle of nowhere. The best setups happen at key levels, not in empty space between levels. Step 3. When the stock reaches the level, watch the candle. Is it forming a recognizable pattern? A hammer at support, a shooting star at resistance, a big green bar breaking through resistance? Step 4. Check the volume. Is the volume on that candle above the 20-day moving average? Is it 2 times average? 5 times? The higher the volume, the more significant the signal. Step 5. If all 3 align, level plus candle plus volume, take the trade with appropriate position sizing. Place your stop just beyond the level, because if the level fails, the setup is invalidated. This is exactly how I would approach stocks like Nvidia, AMD, SMH, or any stock in the semiconductor space. Identify the levels, wait for price to get there, watch the candle, check the volume. It is systematic, repeatable, and it removes the emotional decision-making that destroys most trading accounts. Let me take a step back and show you the complete framework you have built over these last 5 lessons, because it is more powerful than you might realize. In Lesson 11, you learned that volume is the participation meter. It tells you how many people are involved in a move. In Lesson 12, you learned about climax volume. You now know that extreme volume spikes at the end of extended moves signal exhaustion, not continuation. In Lesson 13, you learned to judge trend health using volume. You can tell whether a trend is real and likely to continue, or quietly dying from the inside. In Lesson 14, you learned to read the smart money's footprints through accumulation and distribution. You can see institutional positioning before the crowd catches on. And in this lesson, Lesson 15, you learn to apply all of that at the most critical locations on the chart, the key support and resistance levels, using the Triple Confluence framework. Volume plus candle plus level. Together, these 5 lessons give you a complete volume analysis system. You can read participation, spot exhaustion, judge trend quality, track institutional activity, and identify high-probability setups at key levels. That is not just one tool. That is an entire edge, and it is an edge that 95% of retail traders do not have because they never learn to read volume properly. Alright, homework for this lesson. This is a big one, and I want you to take it seriously because this exercise ties together everything from the first half of Phase 2. First, pull up the daily chart of any AI or semiconductor stock on TradingView. NVIDIA, AMD, SMH, whatever you like. Add volume with a 20-day moving average overlay. Second, identify the 3 most important support and resistance levels on the chart. Mark them with horizontal lines. Third, go back to the most recent time the stock touched each of those levels. For each touch, analyze 3 things. What candle pattern formed at the level? Was the volume above or below the 20-day average? And did the level hold or break? Fourth, based on your analysis, predict what will happen the next time the stock approaches one of those levels. Write down your prediction. Then wait for it to happen and see if you were right. For extra credit, do this analysis on 3 different stocks and compare the results. You will start to notice that the Triple Confluence framework works across all of them. Different stocks, same principles, same volume signatures. And the complete volume analysis toolkit, all 5 checklists from the first half of Phase 2, is available in your free cheat sheet at candlelogictrading.com. And that wraps up Lesson 15. Take a moment to appreciate how far you have come. You are now halfway through Phase 2, and you already have 5 powerful tools that most traders never learn. Volume as participation. Climax, volume as exhaustion. Volume trend health analysis. The accumulation, manipulation, and distribution cycle. And now volume at key levels with the Triple Confluence framework. These are not theoretical concepts. These are practical, actionable skills that you can apply to any chart in any market starting today. But we are just getting started. In the second half of Phase 2, we go beyond reading raw volume bars and start using dedicated volume indicators, the professional tools that turn volume into a precise, trackable signal. In the next lesson, Lesson 16, we dive into on-balance volume, or OBV. It is one of the most powerful and underrated indicators in all of trading. It is a single line that tracks whether volume is quietly flowing into a stock or out of it, and it often reveals the smart money's hand before price even moves. You are going to love it, so subscribe and hit the bell so you do not miss it. New lessons drop every Sunday, Tuesday, and Thursday. If this series has helped you, smash that like button, share it with someone who is still trading without volume. Leave a comment telling me which lesson has been your favorite so far. Go practice, protect your capital, and I will see you in Lesson 16. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.